you ever heard of someone say, "I made money trading options on Apple stock," and thought, well, buckle up, because in this video I'm going to explain what options are, how they work, and how some traders use them to make money without ever owning the stock. An option is a special agreement between two people, a buyer and a seller. It's kind of like a bet on whether a stock will go up or down, but with rules. Let's say one trader thinks Apple stock is going to go up in the next 4 weeks. We call this trader Bullish Bob. Another trader, let's call her Bearish Brenda, thinks Apple is going to go down. They make a deal. Bullish Bob wants the rights to buy Apple at a fixed price if it goes up. That fixed price is called the strike price. Let's say the strike price is $170. Now imagine Apple stock actually goes up to $200 in the next few weeks. That means Bob can now buy Apple for $170, even though it's worth $200 on the market. So Bob makes $30 per share in profit. Nice job, Bob. But what if Apple goes down instead? Let's say it drops to $150. Now Bob would never use his option. Why buy Apple for $170 when it's only worth $150? He just walks away and loses nothing more than what he paid for the option. Okay, so remember our trader Bob? To get that option contract, the deal that gives him the right to buy the Apple stock, he has to pay something up front. That payment is called a premium. Think of it like the price of a movie ticket. It lets you get in, but you're not forced to watch the movie if you don't want to. Let's say the premium is $5. But here's something very important to know. One option contract controls 100 shares of the stock. Yes, you heard that right. So, when Bob buys one call option contract with a $5 premium, he's actually paying 5 times 100. Which is $500 total for that option. This means Bob is spending $500 for the right to buy 100 shares of Apple at the strike price of $170. So if Apple goes up to $200 and Bob uses his option, he can buy 100 shares at $170 and sell them at $200. Profit per share, $30. Total profit is $30 times 100, which is $3,000. Subtract the $500 premium, and that's a $2,500 net profit. But if Apple goes down or stays below $170, Bob won't use the option, and he just loses the $500 premium he paid. So here's the big difference. If Bob wanted to buy 100 shares of Apple at $170 per share, he'd need $17,000. But with an option, he can control the same 100 shares for just a $500 premium. That's called leverage. You're controlling more with less money. But remember, if Apple goes the wrong way, you lose the premium. So it's more high risk, high reward than just buying the stock normally. Okay, last part. There are two main types of options. A call option gives you the right to buy a stock at a certain price. A put option gives you the right to sell a stock at a certain price. So if you think a stock will go up, you buy a call. If you think it will go down, you buy a put. Brenda, our bearish trader, might buy a put if she thinks Apple will fall from $170 to $140. That way she can still sell Apple for more than it's worth and make a profit if she's right. So there you have it. Options are a way to trade without buying the stock directly. They're risky, they require practice, but they give you flexibility and potential for big rewards. If you're just starting out, go slow, practice with paper trading, and never risk more than you're okay losing. Thanks for watching. Make sure to watch our videos that teach you how to trade options.